Welcome to the Stock Market Palantir. Today, we are going to talk about DGLY.
Yes, digital ally.
Exactly. I mean, it is truly one of the most volatile and, frankly, complex microcap stories we've tracked in a while. It forces you to look way beyond their legacy law enforcement tech business and really get deep into the mechanics of financial engineering. Aggressive financial engineering.
And market microstructure. You can't ignore that. And of course, the defining event, the one that hangs over everything, was that catastrophic, cumulative 1-for-2000 reverse stock split back in May of 2025. It just completely reset the table.
It really did. It was a moment of, profound capital destruction. There's no other way to put it. It created this permanent fault line in the company's entire history.
Right. So the central question for us today really is, does the company's recent operational turnaround, and I'll grant you, Q3 2025 was surprisingly strong, does that and their pivot into entertainment actually outweigh the sheer scale of that capital destruction and, the constant threat of more dilution?
And that's exactly where we differ. Let's just be clear about where we stand. I'm looking at the operational improvements and I'm seeing them as legitimate. The pivot is transformative. It's made DGLY a high volatility, high reward opportunity, precisely because all of this is amplified by an ultra-low float of about 1.67 million shares.
See, and I come at this from a place of deep skepticism, and it's all rooted in that May event. The pathology shown by that 1-for-2000 split, to me, it indicates a fundamental structural unsustainability. I think the company is still completely dependent on the market for cash to survive, which makes it, unsuitable for anyone looking for durable value.
Okay, so P&L strength versus balance sheet weakness, a classic debate. Why don't you start? Lay out your case for their survival and this reinvention.
Well, I wouldn't call it reinvention so much as desperation, but I'll let you have the floor.
Okay, fair enough. Look, DGLY is pulling off what you can only call a draconian restructuring to survive and to pivot. To really get the bull case, you have to acknowledge the split trauma, yes? But then you have to focus on the Q3 2025 results. This filing showed a profound operational turnaround. Net losses narrowed by over 70.5% year over year, and crucially, SG&A expenses, selling, general, and administrative, were slashed by a massive 72.7%.
Those are big numbers, I'll give you that.
They are. This re-engineering nearly wiped out the operating burn, which improved by 84.8%. This isn't just cosmetic. This is a fundamental, structural change in their cost basis that management is clearly trying to maintain.
Okay.
And the story isn't just about cutting costs. The strategic pivot is already showing results. Diversifying into live events through custom entertainment, which includes TicketSmarter, that gives them a completely new high-growth cash flow profile. It's totally separate from the aging law enforcement business. And we have tangible proof. The announcement for the 2026 Country Stampede Music Festival lineup with big artists like Rascal Flatts and Zach Top. That validates the pivot. It's operational, and critically, it can generate upfront cash flow from ticket sales months before the event. The stock's current sensitivity is all about its ultra-low float, which just amplifies any good news.
That is a forceful argument, and it's built on recent numbers, I get it. But I just come at this from a totally different angle. That aggressive restructuring you're praising, it came at a cost, and it was the shareholder who paid that price. The company's actions show, it's a recurring pattern of toxic dilution, and the balance sheet confirms they are simply not solvent without raising more cash.
The splits were painful, I'm not denying that, but they were the necessary medicine. They had a NASDAQ compliance issue that threatened the whole listing.
Necessary, maybe, but there's still evidence of absolute destruction. That 1-for-2000 split mathematically annihilated legacy shareholder value. The bag holder sentiment you see online, it's completely justified, mathematically. It all came from management's inability to stabilize the price after that $15 million public offering earlier in 2025. So this history isn't just in the rearview mirror. It defines the risk profile right now.
I agree the history informs the present, but the present financials are...
They're still fragile. That's the core issue. Despite the better P&L, the balance sheet is incredibly precarious. They reported a working capital deficit of $115,393 as of September 30th, 2025. I mean, put simply, their current liabilities are more than their current assets. The company is operating completely hand-to-mouth. They have almost no buffer.
But you have to see that relative to where they started. At the end of 2024, they had a colossal $19.3 million deficit. To get that down to $115,000 shows an incredible effort to stabilize. They are on the very verge of positive working capital.
On the verge doesn't pay the bills. That working capital deficit means they will need to get cash again, and that most likely means more dilution. The current shareholders providing all this volume, they risk just becoming the exit liquidity for management's next financing. So the operational improvement, no matter how aggressive, is just too fragile when the balance sheet is this shaky.
I think we need to dig into that. The 72.7% reduction in SG&A, I really see that as a permanent structural change. They dismantled costly old distribution channels, they scaled back R&D, an operating loss of just $1.1 million is a huge step toward real solvency. They're choosing cash flow preservation over unsustainable growth.
And I'm just not convinced. I mean, operational improvements are meaningless if the company stays technically insolvent, right? That $115,000 deficit means any small setback, a software upgrade, a vendor payment delay, or, and this is the big one, a slow start to ticket sales could trigger another emergency financing. It's the exact same pattern that led to the death spiral earlier this year. The survival measures were achieved at the direct, brutal expense of shareholder capital.
I acknowledge the fragility, but let's talk about the market microstructure, because I think a lot of retail investors are getting this wrong. They see the high off-exchange volume, often over 60%, and they scream institutional price suppression.
Right, and they're correct to see the high off-exchange volume. You can confirm it on FINRA, but their interpretation is just, it's wrong. That volume is not a conspiracy by hedge funds to drive the price down. It's confirmation that retail speculators are the main players here, and the wholesalers are just internalizing trades through payment for order flow to capture the spread.
That is a really important clarification that gets missed. Can you elaborate on the mechanism there for our listeners?
Sure. So for a low-float micro-cap like DGLY, when a retail order comes in, the wholesaler just steps in and fills it from their own inventory, without ever sending it to the public exchange. To manage their risk, to stay flat, they'll often mark that internal trade as short in the data, even though they aren't actually betting against the company. It's just transactional risk management. It's not a directional bearish bet.
See, that nuance actually makes my case for this as a volatility vehicle even stronger. The definitive evidence is the short interest as a percentage of float. It's negligible. It's at 0.80%. That confirms institutional money is not betting against DGLY in any meaningful way. It completely disproves the suppression theory. It means the primary driver here is just retail speculation, amplified by that tiny float.
I agree it disproves the suppression theory, but I'd argue it confirms something else. That institutional capital has already left. It's gone. That leaves the stock exclusively to day traders and algorithms, which actually increases the risk for the average speculator.
Okay, let's turn to the strategy itself then. Custom entertainment. I argue this move is absolutely necessary. The legacy body camera market is commoditized, it's dominated by Axon. Live events, on the other hand, offer a fundamentally better cash flow model. You get upfront cash, or float, from ticket sales months before you have to pay for the event.
It's a rational move, I'll grant you, but I'd frame it as a necessary but extremely high-risk Hail Mary. I mean, they're jumping into a highly cyclical industry that needs massive upfront capital to book talent, and they're competing with established, well-capitalized players.
But the evidence is right there, the country stampede lineup, securing major names like Rascal Flatts. It's a concrete proof point. They're reinventing themselves as a lifestyle brand. That's the sizzle that attracts speculative capital in a low-float stock.
I respect the attempt, but the timing is the critical problem. They are relying on festival revenue that won't fully materialize until the 2026 season while sitting on a working capital deficit today. You see? It just shifts the risk profile without solving the basic capitalization issue.
The underlying risk of more dilution is just way higher than the probability of the entertainment segment getting stable fast enough to avoid it.
Which brings us right back to market psychology and the float dynamics.
Exactly. The sentiment is just fractured. You have the legacy victim cohort, the people who were destroyed by the split and just distrust everything. And then you have the new speculator cohort, who are betting purely on the low float mechanics and ignoring the history completely.
And that friction is absolutely real. It's what guarantees the extreme volatility we see every day.
But that layer of legacy bag holders who are just desperate to sell into any strength, it prevents any sustained price increase. Every upward move is just going to be fleeting, it's transactional, it creates this huge built-in selling pressure on any spike.
While the history is painful, the lotto player psychology is mathematically sound for volatility traders in this specific structure. The ultra-low flow, under 2 million shares, it means even a small influx of volume, especially on good news like the Rascal Flatts announcement, can decouple the price from fundamentals. I mean, that sharp 6.9% pre-market move on November 26 proves it. The low flow is the engine of the speculative thesis.
I agree completely that it's an exceptional vehicle for volatility trading, maybe one of the best out there right now. But that does not make it a viable, durable investment thesis for capital preservation or long-term growth. The existential risk from the balance sheet is just too high to hold it for long.
So to summarize my view, DGLGY is a compelling speculative trade. It's based on a genuine aggressive operational turnaround with slashed losses and a high potential pivot into entertainment. And all of that is dramatically amplified by the ultra-low float.
And my position remains that this company is defined by its extreme capital structure pathology, that 1-for-2000 split, and its immediate working capital deficit. The risk of future dilution is like a sword of Damocles hanging over the stock, making it structurally unsuitable for a long-term investment, no matter how good one quarter looks.
Well, it's clear that any analysis here requires constant monitoring of their 8K filings. You have to appreciate both the improved P&L and the precarious balance sheet at the same time. It's a high-risk vehicle, suitable only for sophisticated traders or those betting big on the custom entertainment pivot.
We can certainly agree on that. DGLY is one of the most demanding, highest-risk stories in the microcap space today, requiring an acceptance of fundamental risk right alongside that speculative opportunity.
Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.